The Federal Reserve's struggle for control over markets. In recent times, the Federal Reserve's ability to control the markets has come into question. With divided messaging and conflicting tools, the central bank appears uncertain and lacks a clear plan. In the next few minutes, we will explore the Federal Reserve's current predicament and the potential consequences it may have on the economy. The Federal Reserve's tools. The Federal Reserve employs two main tools for monetary policy: interest rates and its balance sheet. The federal funds rate, currently at 5.33%, is the rate at which depository institutions trade federal funds with each other overnight. The Fed influences this rate through open market operations, injecting cash into the system when necessary. Another tool is the reverse repo facility, which holds $683 billion and allows banks to borrow short-term U.S. government debt. Both tools are used to control short-term interest rates. Impact on interest rates. It is important to note that the Federal Reserve's tools do not directly impact interest rates on credit cards, mortgages, or other forms of debt. Instead, the Fed's actions in the bond market, through its balance sheet, indirectly influence longer-term interest rates. By buying assets like mortgage-backed securities and U.S. Treasuries, the Fed injects cash into the market and keeps interest rates lower. Conversely, when the Fed allows these assets to mature without replacing them, it reduces the size of its balance sheet and can push interest rates higher. Conflicting actions. The Federal Reserve's recent actions have created conflicting forces in the market. While announcing an expectation of rate cuts next year, the Fed's John Williams stated just 2 days later that rate cuts were not being discussed and were premature to even consider. This inconsistency suggests a lack of clarity and uncertainty within the central bank. Furthermore, the Fed's plan to lower rates while continuing quantitative tightening, QT, creates a conflicting situation. Lowering the federal funds rate will push short-term rates down, while QT will push long-term rates up. Additionally, the draining of the reverse repo facility will further push short-term rates up. These conflicting forces may lead to a steepening or uninverting of the yield curve, which is currently inverted and can be a sign of an impending recession. Additional tools. The Federal Reserve has additional tools at its disposal, such as Operation Twist and Treasury buybacks. Operation Twist involves buying and selling specific maturities of U.S. Treasuries to manipulate the yield curve. Treasury buybacks allow the government to repurchase its own debt if there is a dislocation in the Treasury markets. These tools can further influence interest rates and market dynamics. Potential consequences. The Federal Reserve's uncertain actions and conflicting tools of monetary policy suggest that unexpected outcomes may occur in the markets. This could lead to a recession, a stock market correction, and an increase in unemployment. It is crucial for investors to be aware of these potential risks and consider self-managing their portfolios to navigate these uncertain times. Conclusion. The Federal Reserve's struggle for control over the markets is evident through its divided messaging and conflicting tools. The uncertainty surrounding its actions raises concerns about the potential consequences for the economy. Investors should stay informed and adapt their investment strategies to mitigate risks during these uncertain times.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.